Hello and welcome to Aditya Birla Sun Life Mutual Fund presents Voyage 2020 Navigating to a Better Tomorrow, partnered by ET Now. This year, owing to the COVID-19 pandemic, Voyage 2020 has gone digital. Day 2 of the event began with a conversation between the CIO of Equity Investments at Aditya Birla Sun Life AMC, Mahesh Patil, and the founder and CEO of Value Research, Dhirendra Kumar, who spoke about portfolio strategies for a post-COVID-19 era.
World has come to a standstill. So in that sense, how bad things can get for the economy?
Except for a couple of sectors like pharmaceutical, basic consumer utilities, telecom, everything is getting impacted.
Yeah.
And that will take its toll on the economy. We are seeing the estimates which came in initially. Initially, one thought that the impact would not be that much. You will see a soon recovery, a V-shaped recovery. But as we got to know the virus much better, the way it's spreading and the mortality rate and the lockdowns are getting extended, I think there has been a significant cut in the growth estimates. So just to give a number over there, globally, we were looking at this year, the global GDP was supposed to grow at around 3.1%. That number is now being cut anywhere between -3 to -4%.
Mm-hmm.
That's the kind of a cut we are looking at. In India too, I think we were looking at a GDP growth in FY21 to be around 6% or 5.5 to 6%. That number now, if you look at a couple of the economists which have reported numbers, they're anywhere between -1 to -3% in that range. That's a kind of a deep cut in the economic growth. We haven't seen that in India, kind of a decline even during the global financial crisis.
From a growth economy to a shrinking economy.
Yeah. And it will be, I mean, this quarter will be very bad. The growth rate could be around 15 to 20% lower. As we come out of the lockdown, slowly things will start to come to normalcy, but will not be back to normal. Second quarter, okay, it will still be negative, probably 10%. Third quarter, mild negative, and fourth quarter is where I think we can expect things to start to come back, okay, in positive territory.
What kind of specific opportunity that you are looking at? Every pain comes with some opportunities getting created. You listed some of them. Can you elaborate more on that?
I think what opportunity is coming in for India is that we want to be self-reliant, right? So PM talked about Atmanirbhar Bharat. So it's not only import substitution, but I think what has happened in China, the trade wars and post-COVID, a lot of global manufacturers are trying to diversify their supply chain from China into other countries. And for India, it's a big opportunity. If they're able to attract some of the large investments over here, then I think that can provide us another fillip of growth to our overall GDP.
Huge economic growth that can.
Yeah, I think that is, something which is a big opportunity. So I think if you're able to really crystallize this and identify a few sectors, okay, be it in areas like chemicals, it could be in textiles, it could be in consumer electronics, in IT, in pharma, okay, for manufacturing of basic raw materials. I think that can be a big opportunity for India, which can create a long-term growth driver for our economy. As a portfolio manager, right, I think the opportunity is, I think in this kind of environment, clearly the companies which are having a strong balance sheet, which are much focused onto their businesses, have got a strong competitive advantage. I think they will continue to become stronger and bigger. Mm-hmm. Companies with leverage, whose cost structures are much higher, will get squeezed out in this environment, and some of them will perish. Some of them will barely survive. So some of these stronger companies, with strong brands,
That's a broad framework you're operating in. That stronger balance sheet is something to go with.
Stronger balance sheet, stronger competitive advantage, cost advantage, stronger brand. I think
advantage. Okay.
These will be the companies, okay, which will survive. And that will be across sectors, right? Mm-hmm. I mean, sector-wise, there will always be various sectors, okay, which could look better. But I think that could be a broader theme.
Is there a fundamental change in the way you manage your funds? Have you started asking loudly some key questions which you never used to ask?
So every crisis, I think, gives us an opportunity to look into our processes and see what needs to be strengthened. We did that after the global financial crisis. Okay, we in 2010-11, We strengthened a lot of our investment processes around stock idea identification, construction, around risk management. And that helped us in the next 8 to 10 years. And we've seen that improvement across all our funds. I think getting into this crisis, also we had a tough year, last couple of years, and that enabled us to really look into some of our processes and look at where we need to strengthen. And while doing that, we came up about a couple of action points. When you are doing stock identification, when we are evaluating a company, normally we would look by the numbers, right, which is important, okay, earnings. But I think we sometimes miss the trees for the forest, right? So we need to really get the narrative part for a company. What we realized in the last few years, and especially after the NBFC crisis, management quality, and during those times, we saw a lot of companies with poor corporate governance or management issues were suffered quite a bit. And that's when we tried to build some management evaluation framework in terms of our overall stock selection process.
The next discussion saw sector analysts from Aditya Birla Sun Life Mutual Fund sharing their bearings of the Indian industry in a conversation with ET Now's Aisha Faridi.
Let's begin by talking about the first pillar of growth here, revival in exports. After 2 years, Dhaval, of a decline, FY20 was pegged to be the year of consolidation and thereafter finally witnessed growth. Now with this sudden, rush around finding a COVID vaccine, where do we stand in this journey?
COVID has, helped in terms of expediting a lot of plant approvals on ground. So a lot of companies today are, announcing over the last many weeks that they've actually got that US FDA plant approvals, which are stuck up for quite some time. And at the same time, some of the companies have also got product approvals, which were meaningful in nature. So I think COVID-19 has, provided impetus, and, that should add to the overall growth phenomenon that we're trying to look at. So at the same breath, if I were to say that, how is the overall outlook looking like? We actually called out last year that the $38 billion industry by 2030 will become a $100 billion industry by 2030. And that is something that, we have far more confidence today that, we are on a right track to actually achieve that.
Consumer-facing NBFCs, is there bound to be more fear and risk perception as seems to be building into stock prices, even for some of the leading names right now?
So, if you look at NBFC companies, right, most of the NBFCs in the country have been retail-oriented and focusing on acquiring customers more, which banks have not been able to cater to or reach. So, definitely market will differentiate among better run NBFCs and one facing structural challenges, whether it is wholesale real estate or stuff like that. But companies with strong parentage, better corporate governance would tend to come back. That's the first thing. Market stock prices do tend to be volatile. Today, the environment, whether it comes to liquidity, whether it comes to macro, whether it comes to COVID and how will things navigate from here are not clear. So we will not be right to understand which companies may go down under and may not survive. But with companies with strong parentage, corporate governance should come back fairly well.
How do you see consumption at large pan out in the post-COVID world?
There's so many different, I think the world will remain same. Some things will change for sure. The people want for hygiene will take a leap bound. Then the people want for convenience will take a leap bound. We will look to food as a category. If you see, all of us are working out of home and eating at home. So the ready to eat and ready to cook food will play a very important role. The other thing which I can think of is a quick service restaurant. In India, all of us want to have food at home. Aisha, there are hardly any two brands in India with more than 500 restaurants. 10 years from now, we'll have at least 10 or 15 of them. So quick service restaurants will evolve in India. Companies who are able to evolve in this space are the winners. So food as a category, I think, is a huge opportunity. These companies can grow at 10 to 15% CAGR for 10 to 15 years. And the personal hygiene space will evolve. So those are the things I think will change post-COVID.
Welcome back to Aditya Birla Sun Life Mutual Fund presents Voyage 2020, Navigating to a Better Tomorrow, partnered by ET Now. The highlight of the day was a talk by the global thought leader and acclaimed author of books like The Black Swan and Anti-Fragile, Dr. Nassim Nicholas Taleb.
There's nothing particularly interesting in predicting pandemics because they've been happening throughout history, and we got even movies about pandemics and future pandemics. The central point is that our environment today makes these pandemics vastly more dangerous because they spread much faster, and that is a problem. So this is coming from a nonlinear effect from connectivity, a winner take all. Just like in the Black Swan, and I explain it as follows: when you have insulated islands, you have a lot more species per square meter, but as you expand to a continent, you see, you will have winner take all effects, with some species dominating and small species disappearing. So we're seeing it in business wise. Look at Google. 100 years ago, it would have been impossible for one company to dominate the planet in no time. I mean, it took 4 or 5 years for Google to really own the planet in its field. So this is, get used to this, and this applies to everything: cultural life, sports, fame, and of course, viruses.
Whom should one believe, Mr. Taleb? The maximist who say that the only way to survive is that you stay at home, maintain social distancing, or the minimalistic? There are few in your country who say that, look, you got to come back to normal.
Okay, so let me tell you the problem with this reasoning is a lot of people have been promoting, maybe often because they're connected to the travel industry, or casinos, or something like that, losing money. They've been promoting the idea that it's either the economy, all right, or the virus, not realizing, as many countries have been discovering, New Zealand, for example, Taiwan, that effectively the best way to help your economy is through a victory over the virus. That's what's central. The other myth there is that these people are promoting is that they think that the economic drop comes from the measures, not from the virus. But now there's evidence in practically every country, even Sweden, where the government did the minimal, okay? Even Sweden, that restaurant bills experienced a plunge, okay? Economic life experienced a plunge, okay, except for cosmetic. And then as I show you pictures of some people in restaurants, most restaurants are empty, and these pictures contradict the hard data we have about consumer behavior. We know, for example, that a lot of companies I'm associated with are not going to go back, even if the government said, okay, everything is normal tomorrow. We're not going to go back to work if we can work from home. We're not going to expose ourselves to a virus if we can help it, okay? And practically everything elective has been canceled. If you see like conferences like this conference, okay, if there's the smallest risk, it will all take place next year or next time we're going to do it online. You see, if there's the smallest risk. So what's happening, it is not the measures against the virus, it's a natural human response. And the problem, the economic problems are vastly greater coming from the virus than they claim.
So I'll turn your attention now to the economy. Let's first start with financial markets. There are 4 factors, Mr. Taleb, which are at play: medical crisis, economic crisis, oil crisis, and central bank crisis. These 4 factors have never come together. And yet markets are NASDAQ is in the green for the year and Dow's hardly down 17, 18%. Are you a bit surprised that when we are using words like pandemic and crisis and panic and fear, markets are behaving as if they are Teflon coated?
Every time a crisis hits, you're going to have a lot of losers, but you also have winners. And the winners here are the industries that are capable of adapting. So the travel industry may have not adapted. They may not have ideas for the time being. And people are starting to drive their car instead of flying, okay? So, airline will not do well. Hotels will not do well. Airbnb or other similar things will not do well. But some people are doing very well. People selling you, for example, ways to disinfect the room, all right? If you go to your office, you can disinfect it. These are doing well. People involved in selling masks, they're doing well. A lot of Amazon is doing phenomenal, right? People who deliver, I mean, so we have a shift in the economy from one sector to the other. That's the first point. The second point is, and that's something I learned sorely, all right, as a trader, that practically every crisis leads to an overreaction on the part of government that leads to stocks rallying abnormally because they inject so much liquidity they target the stock market and they inject liquidity. The one thing I've learned in the life of 37 years since I started trading, very counterintuitive, is that recessions are very good for stocks because the reaction to recessions makes stocks rally, and booms are very, 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 very bad. They make stocks very volatile because, of course, they're going to raise rates and people have substitutions into bonds. So this is one of the reasons why stocks are not collapsing. But if outside the stock market, okay, which is investor-led, by people who just put money but not work. If you walk around, you see nothing but businesses closed. So you have entire sector that will not come back.
India has so far managed to contain the virus. On the medical front, the lockdown has been a success. But do you think in the medium term and in the short term, this lockdown is going to cost Indian economy a lot?
I think that it's a false economy again. It's a false economy. Maybe the money you've saved from a short lockdown, you see, when you have a short lockdown, you save money for later, okay, compared to, think about New York, think about the United States. Because although even we don't have a lockdown, there's a drop in economic activity and we're prolonging the effect of the disease. So I think that India had a very reasonable policy. India, Taiwan, Hong Kong, New Zealand, Australia, these many countries had very reasonable policy. They acted early. They acted wisely. They acted according to precautionary principles. And they had a morally acceptable stance.
We have a lot of audience who have been advising lots of the investors to put their $1 billion of hard-earned money into the market. What is your one advice to them that as to how one should they go about advising their customers, communicating at the regular interval for constructing a good portfolio that can deliver long-term return?
You have to invest in a way that allows you to get out. And this is why financial markets are extremely useful, because you can get out, okay, to find an alternative. You can switch to something, you see. It's still a very good investment, but I can switch out of it, you see. The second thing I advise all investors, okay, is if you want to invest, say, 20% of your money in financial markets, invest 12% and keep 8% dry. So when you get a phone call for something attractive, you can increase, you see. And odds are there's a very small probability of you're not finding other. So what happens is that power dry is what people underestimate. Most people tend to over-allocate early. You see, it's much better to over-allocate late than early.
Because of this crisis, what do you think would be the new normal of the world? Will US and China fight? Will globalization be under pressure? What are your thoughts there?
Okay, I don't think foreign policy is the place to look for huge rationality, okay, with geopolitics. I don't think so, but I doubt that it will have tension between US and China, only because the two countries depend on one another. And there's too much commerce, too much at stake on both sides. I don't think there'd be tension between US and China, but I always keep in mind that governments can be very irrational when it comes to geopolitics. Okay, and effectively we can see it now with, my criticism of the US government is say, okay, you guys spend $1 trillion plus more in hidden cost, okay, building nuclear stuff, and you can't supply the population with masks. Okay. I mean, what world are we living in? So people are getting to be a little skeptical of geopolitics, and that's good news.
The final session on day 2 of Voyage 2020 saw senior portfolio managers at Aditya Birla Sun Life AMC talking to ET Now's Abha Bakaya about the art and science of stock picking.
When things are so uncertain, it's very difficult to really predict, which are going to be the companies that will lead us into the future. What would you advise?
See, during these times, or during most of the times, typically the type of stocks that I would recommend internally to our team, and also while selecting stocks for the funds that I manage, would be typically look at companies and sectors which have long-term potential going forward. The opportunity size should be large, and the companies preferably they should be leaders in their sectors, and there should be a track record of delivery in the past, so that we're not just betting on just a story, but actual real operations. They should have executed it on the grounds in the past few years. And of course, at this point of times, you would look at companies which have an extremely strong balance sheet, because at this point, when nothing is selling, none of the companies or sectors are able to sell at this point of time. So it's going to be a stressful scenario for the next 3 to 6 months, or maybe 1 year. So it is essential that the balance sheet is strong enough that you can withstand this stressful period, or period when your cash flows are quite stressed. So a strong balance sheet is essential at this point of time.
Okay. Anil, let me have you dive in as well and share with us a strategy that you're going by. If there are any particular kinds of funds perhaps that investors should look at if they do have the capital to get into markets at these levels.
So, right now it would be a good idea to, first of all, have a clear, 2 to 5 years perspective when you invest in. So don't look at, daily NAVs and daily stock prices. It's going to be a pretty choppy period ahead. I would generally request or suggest to them to look into buy either large cap or multi-cap categories and funds, primarily because these are better researched stocks, and with better corporate governances, better boards, better bandwidths, better balance sheets to take on shocks. And right now we are in a period of a shock, and the globe is in a period of shock.
Vishal, with so many mutual funds being offered right now, what about PMS? How does that add value to an investor's portfolio?
Yeah, sure. So I think the way we look at it is that PMS complements mutual fund schemes. For any investor, mutual funds will be the core part of the portfolio. However, PMSs do offer strategy diversification. So from that perspective, it does appeal to a niche segment of investors who are HNI investors who are looking to diversify beyond mutual funds. And in that case, for example, in our PMS, we have got certain strategies like innovation portfolio, or for that matter, India Special Opportunities portfolio, which looks at investing in turnaround stories. So such kind of investment avenues is something that is differentiate. The difference it's different from mutual funds, and it adds value to investors.
How would you assess valuations at this point?
So, what has been my biggest learning is valuations, though they matter, the entry price matters. But what matters much more is the getting hold on the earnings growth and the market share incrementally the companies are going to command. So most of the times in the market, when we talk about the valuations, we try painting everything with the same brush, and we kind of use a P or EV by EBITDA. So these are just one of the very few matrices when you evaluate a company. So it is all about market share gains. What are the moats around the company as the company grows from being a small to mid-size to a large size company? So are they building moats around the same? So otherwise, what may happen is as they grow, like in technology companies, we have seen a company may grow for some time, but then you'll have suddenly competition coming in. So those Kodak moments we need to avoid.
Next week, we'll bring you the highlights of the final day of the digital edition of Aditya Birla Sun Life Mutual Fund presents Voyage 2020, Navigating to a Better Tomorrow, partnered by ET Now. Stay tuned.